My name is Andrew Stotz from the Valuation Masterclass, and I want to invite you to listen to another student graduate presentation on another energy company. Let's bring him in right now. Are you ready to rock?
Yeah,
I know you've worked so hard, and I've seen your great questions that you've had in our live sessions, and I've seen your involvement in the Slack channels. Uh, how many hours have you devoted to working on the Valuation Masterclass Bootcamp?
yeah, a lot, around 200 hours.
Yeah, so it's exciting. So I'm gonna share your screen up here. So 1 second, and now the audience can see your screen, and I'm gonna exit in just a second, and then you take over. Are you ready?
Yeah, I am.
Okay, I'm gonna exit now, and then you can start. Go.
Alright. Hello everyone, my name is Nuruddin, and today we're going to talk about Nest. So I initiate a coverage on Nest with a buy recommendation based on a net target price of Euro 26, implying an upside of 57%. Imagine, I drive my target price from a DCF-based valuation using a WACC of 8.6% and a terminal growth of 1%. For the highlights, the revenue growth faces short-term challenges but stabilizes in the long term. Past gross margin recovery despite rising costs, unlocking profit potential through financial advantages. For the main risk is policy and regulatory risks. So who is Neste? Neste Corporation is based in Finland and is a global leader in renewable diesel and sustainable aviation fuel. The company operates in three segments, which is renewable products, oil products, marketing, and services. Sonest has renewable diesel production capacity of approximately 3 million tons annually, with key plants in Porvoo, Rahi, Singapore, and Rotterdam. Now for the stories supporting my valuation. First one is Nest revenue expected to decline by 8% in 2024, driven by 75% year-on-year drop in diesel prices as of Q3, eroding the premium they take on its renewable products. But long-term stabilization is on the horizon. Nest's strategic expansions at its Singapore facility and Rotterdam site will enhance its capacity to meet increasing demand. According to the International Airport Association, global demand for sustainable aviation fuel is expected to reach 8 million tons by 2025. I expect Nest's revenue to grow at a CAGR of 5.5% from 2025 to 2028. Now for the second story, path to margin recovery despite rising costs. According to Reuters, Nest faces margin pressures due to high feedstock prices, with costs for used cooking oil and animal fats increased by 15 to 20%. However, according to CME Group, the global biofuels market is projected to grow significantly. A lower per unit cost will aid margin recovery as global demand rises and production scales up. I project Nest gross margin to rise from 11% to 16% by 2028, which is the historical average in the last 5 years. Unlocking profit potential through financial advantages, so Nest has a very good tax rate of 10% on 60% of the revenue compared to normal 20% for Finland. Also, they have very low cost financing as 3.5% to compare to the normal average in Finland of 5.5%, which is almost half. So these financial advantages will make the improvement in gross margin carry through the net margin. I forecast net margin to grow from 6% to 13% by 2028. Now for the industry, the oil and gas industry operates across three main sectors, which is upstream, downstream, and midstream. The market is valued at US 7 trillion. Imagine in 2024, and also expected to grow to US 9 trillion dollars by 2031 with a CAGR of 4%. The main players is Saudi Aramco dominating the market at 25%, ExxonMobil, Chevron, Shell, PetroChina, and Total Energies. Now for the second quarter of 24, Nest reported a 13% year-on-year revenue decline due to weaker renewable performance and maintenance at refineries in Singapore, Porvoo, Rotterdam also impacted their results. Now for the consensus estimates, 55% of the analyst recommendations are strong buy and buy, and 40% have hold recommendations and only one sell recommendation. The mean target price indicates a 35% upside potential. like very impressive. Now for the revenue segments, they have three main segments as we already discussed. The oil product is leading segment with 48%, renewables is at 30%, and marketing and services is at 18%. For the fundamentals valuation, momentum and risk, overall, Nest appears below average relative to 70 non-financial companies in Finland, considering fundamental valuation, momentum, and risk. And for the world-class benchmarking, the company profitable growth is very good at score of 5 for now, below average to be honest. But the main driver for this score is the asset efficiency. Now this is the P&L of the company. Stable revenue growth as shown here, except for 2024 as we already discussed in the stories. This is the balance sheet asset side, liabilities and equity side, and the cash flow statement. Now this is the ratios for the company. Very stable companies, very stable ratios compared to the industry average. Now this is the continue of ratios. Now for the free cash flow data, the company has very stable free cash flow except for 2024, as they are investing they have very high capex as shown here, and they are investing for 2024 to match the growing market of renewables, and they have very large investments as we already discussed in the stories in Rotterdam and Singapore. Now for the relative valuation as shown here, the company is very cheap at 0.07 for the price book to return on equity, mainly driven by very high return on equity of 19% compared to 15, 11, and 14 for developed world, Asia excluding Japan and world respectively. For the relative valuation of PE to growth, the company is very cheap at 0.22 compared to 0.96 and 1 for world, developed world, and Asia excluding Japan. The EPS growth is the main driver for this lower price, and they have 32.5 EPS growth compared to average of 10 for the comparables. Now for the valuation and target price, as we already discussed, I have a 26 euro price, target price. For Nest has been high beta stock, so I assume a beta of 1.5x, 1.25x, resulting in a cost of equity of 10.8. I forecast a capital structure with around 20.29% of debt to capital, which is a little conservative. So my euro 26 per share is based on the free cash flow to the firm methodology. Now for the sensitivity analysis, the company, if the company only managed to increase the gross margin to 14%, which is less than their 5-year historical average, the target price will rise to 29.7. Imagine. And the main risk is feedstock supply and regulatory uncertainty. Neste operates in a heavily regulated industry where the company benefits from policies favoring renewable fuels. As we already said, they have very low cost financing, 10% tax rate, like half of the normal rate, which is the company is mainly pushed by the government. Dependence on renewable feedstocks, Neste business is highly reliant on availability and cost of renewable feedstocks. Competition in the renewable fuels market. Neste faces increasing competition from new market entrants and traditional oil companies transitioning into biofuels, as it's a very good opportunities in this market, and as the government is supporting this market. Now for the last risk, exposure to global energy markets. While Neste is a leader in renewable fuels, its business is still exposed to the volatility of global energy market. So now, ladies and gentlemen, I guess we all know now why we have an upside of 57%. Also, a very great support of my assumption is that the company for the last 2 years have been declining in the price from the 42 level to around 17 level, which is almost half, and the market correction also will support the upside of 57%.
Excellent. All right. Well, this raises a lot of questions. I think that was a great presentation. But the first question is, what makes you confident? Let's just say here, we got a question from Priyanka who says, what's the key factors that justify more than a 50% upside given conservative terminal growth rate and other things? But I would say, this has been on a down cycle for the price.
Yeah,
And
exactly.
basically, you are to some extent picking a turnaround. Like now is the time.
Exactly. Market
Te-
correction
Tell
is
us
very constructive.
how do you feel? What is the one thing that makes you feel most confident about that idea?
The company is currently investing very for the last 3 years they have been investing and shifting to the renewables market. So this is a very good this is a very high reason for their market price drop, as they were having lower margins and all this stuff as they are shifting to this renewables, but they will capitalize on their shift for now as the market has very high potential. Also they have already invested a lot, so that's the main reason.
Okay, let's go to the ratio page.
Okay. This one?
Yeah, so let me just look at this for a second. So the gross profit margin in 2021 was 19, then it went down to 11, then it went down to 11.2. And then if I look on the quarterly basis, on June, it was down to 4.1. And we saw that in your quarterly numbers.
Yeah.
What makes you confident that that's the bottom? What is it that's driving that right now? And what makes you confident that that's the bottom?
Yeah, as I already said, the market currently is very, very hard to compete in at the because of the geopolitical risks that happening, and also the renewable markets have been affected a lot. All of their cost stuff is for the COGS it has been very high as shown here. So that's the main reason they are currently facing these problems. But in the long term, the market is going to recover, and the company will benefit from its capacity increase in all of their refineries. So yeah, that's it.
Okay. And can you go to the cash flow statement?
Yeah, sure. One sec.
Yeah. A question came from Ashwin, which says, why do you think CapEx uh, is peaking in 2024, then coming down, uh, and is relatively low in, let's say, 2025, 2026?
Yeah, because the main they have very high expansions for this year, and then they also have expansions, but a little low. So, for for example, the expansion is in Singapore facility, and I actually forecasted this number on the quarterly basis, as I've seen the high capex in the quarter. So I decided that they'll be investing around this number, and then after that the capex will not keep increasing. They'll be at average after that.
One of the strengths of the company, you said in your stories, the third story was about the tax incentives that the company's getting. Is there
Yeah.
any risk that those tax incentives could be withdrawn? Let's say there's a different government, or are these like long-term contract agreements that can't be changed?
No, no. At any time, politicians decide to change this rules and the support they are giving to the renewables, it would be back again to the 20%. But I think it won't change. Politicians won't change their like opinions in the next 5 years at least, because they have already invested trillions of dollars in this field. So at least for until 2031, I don't think the market is and the support given by the government is going to change.
Okay, well, it looks like an interesting opportunity that's gotten super cheap.
Yeah. True.
Um, so how does it feel to graduate from the Valuation Masterclass Bootcamp?
It feels very great and a great transformation. To be honest, I joined this first. I literally didn't. only know the basics about the valuation, but when I dig deep into the company financials and reviewed everything and get feedback, get humbled by Dr. Andrew, then get back, apply the feedback. It's been a great journey, to be honest.
Yeah. How would you describe the transformation that you went through? What's different about you today from when you started?
First of all, if I get to value a company now, I'd be very confident in my assumptions. I know how to defend my assumptions for now. If I'm facing an investor, let's say, tell him I put $100 million in this stock, I'll be confident. I know how to defend these numbers. As I already dig deep into all of details of the company, I dig deep into the market and all this stuff.
That's awesome. Well, congratulations. You've done a great job and I enjoyed the presentation. I don't know much about this company, so I learned more today. I love that.
Thank you so much.
All right. I'm going to take you out and then I'm going to come back and see you in just a second.
Okay.
Yep. Well, that's another interesting presentation on the energy sector. This company, Nest, is showing a complete collapse in the price, basically by almost 50%. It's trading close to book value with a reasonable ROE. It definitely has had a bad recent quarter. So the question is, has it hit the bottom? Is there a turnaround opportunity? This is the kind of questions that we ask in Valuation Masterclass Bootcamp. And we just saw a great description of how to look at that. My name is Andrew Stotts, and I want to welcome you into the Valuation Masterclass and build a competitive advantage in company valuation.